Welcome to Introduction to Banks and Lending, brought to you by Kanjo.com. In this video, I want to talk a little bit about what banks are, why they're important to the economy, and then delve into the lending process, which is the fundamental function of most banks. So let's get started by talking about what are banks. Banks are basically institutions to facilitate transactions, such as purchases and loans. And there are a lot of examples of this. For example, a mortgage. If you need to go buy a house, you don't have the cash on hand, you go to the bank and the bank will lend you the money in the form of a mortgage. If you want to start a small business, a bank can give you a loan to do that. If you're a student who needs to go to college, a bank can help you finance that education of yours. So banks perform this very valuable function of helping people who need money get that money, and then they can pay it back over a period of time. And that helps expand the economy. So this is what banks are supposed to do. But what are banks not supposed to do? Banks are not supposed to be investment companies. Investment companies are like mutual funds and hedge funds, companies that speculate on securities for profit. And this distinction is very important. Banks are focused on transaction, investment firms are focused on speculation, and I'll talk a lot about that later on in the video. But for now, let's focus on the three major aspects of the lending process. First, you have origination, then securitization, and finally, sales. So let's start with origination. Origination starts by the bank collecting deposits. So when you open up a Citibank or checking account or savings account and you put a weekly deposit in there, the bank is collecting these deposits that it can later lend to borrowers. So in the second step, the bank will lend this money to borrowers according to predetermined terms. So a borrower will come and say, I have this credit rating, I need a mortgage of this amount, and I'm willing to pay it back over this many years. And these terms will constitute what's called a debt obligation. So the bank will issue all these loans, and in return, they will have the rights to this debt obligation. The rights to this debt obligation will then become an asset that's owned by the bank. So the bank has a cash outflow, and in return, the debt obligation, the rights to certain cash inflows in the future, are now owned by the bank. So that's the origination process. Now let's move along to securitization. In securitization, the banks will take all of these loans and pool them together into assets called collateralized debt obligations, or CDOs for short. Now, why would a bank do this? The major reason is to reduce risk. A lot of investors are very concerned about buying individual loans because if one guy defaults, you might lose 70, 80, 90, 100% of your investment, a very large percentage. But this way, instead of buying just one loan, investors can buy a small piece of several thousand loans. So your risk is diversified and it's reduced. So this was a financial innovation, the concept of securitization, and it had two major effects. The first effect was to increase demand. A lot more people wanted these CDOs. They were like, this is a great way to get exposure to the debt markets, to the mortgage markets. But it also made the securities much harder to value because instead of just having a few inputs, you now have several thousand inputs for every single security. And that makes it a lot harder to determine the real value. So overall on the balance sheet, securitization is a pretty good thing. It's helped expand home ownership in the United States and it's helped expand the credit markets, but it can be misused. And a lot of people will agree that in the credit crisis of 2008-2009, securitization was grossly mishandled. So now that we understand the first two phases, let's move on to the final phase, which is sales. In sales, the banks will take the CDOs and they'll sell them to mutual funds, hedge funds, and other investment companies. And that's totally fine. That's what the banks are supposed to do. But in recent years, the banks started creating these internal hedge funds. So Citibank, Bear Stearns, Lehman Brothers, they all created internal funds for the CDOs. So instead of selling them to the external investors, they kept them on their own books. And this is bad news. It's bad news because it doesn't allow the bank to focus on its core function of lending and facilitating transactions. If the investments go bad, if the CDOs go bad, the banks won't have enough money to keep on lending. And that can send the economy into a major tailspin because small businesses start failing. People can't get loans to go to college. People can't go and buy real estate. And that's pretty much exactly what happened in the current credit crisis. So this is the point. Banks were meant to facilitate transactions, not speculate on investments. It's an important distinction, and I think it's one of the major reasons that banks and investment companies should be separated, at least on some level, going forward. So I hope this video has helped you understand a little bit about banks, what they are at the fundamental level, and how the lending process works. For more videos on similar topics, I recommend you check out my website, www.canjo.com.